1. Start with energy. Explain with authority. Highlight with emphasis. End with warmth. The current live trading price for Supermicro Computer Inc. stands at 34.67 USD, pushing upward with a gain of positive 0.94 USD, marking a 2.79% increase intraday as of this very moment. The ticker is flashing green, but do not let that singular data point fool you into thinking this is a standard recovery or a simple buy the dip opportunity. What you are witnessing on the screen right now is one of the most violent, high-stakes corporate battles in the history of the Nasdaq, playing out in real time. The expectation from the broader market just 48 hours ago was that Supermicro Computer was effectively a dead company walking, destined for a delisting that would force institutional capital to flee and leave retail investors holding the bag in the murky waters of the pink sheets. That was the prevailing narrative, the heavy blanket of fear that crushed the stock down to $17 just last week. But the reality we are facing today is starkly different and significantly more complex. The reality is that the company has produced a sudden, sharp countermove that has caught the entire short-selling community off guard, creating a curiosity loop that demands we look much closer at what is actually happening under the hood of this server manufacturer. While the common consensus on social media platforms and forums discussed by traders using the Robinhood app has been that the resignation of Ernst Young was the final nail in the coffin, the sudden appointment of BDO USA as the new independent auditor has completely upended the calculus of this trade. This is not just a simple administrative update. It is a lifeline that has potentially saved the equity from immediate annihilation. When you see that price of 34.67 USD, you are seeing the market pricing in a renewed probability of survival, a stay of execution that allows the company to fight for its listing status. However, we must challenge the sudden euphoria. Does hiring a new auditor fix the internal control issues that caused the previous one to resign in protest? Does it answer the Department of Justice inquiries? No. The stock is rising not because the problems are solved, but because the immediate threat of being kicked off the major exchange has been pushed back, buying the company time. This tension between the deep, unresolved accounting questions and the immediate technical breakout is where the profit opportunity and the extreme danger lies for anyone looking at investment in this name today. To understand the gravity of today's movement, we have to look at the volume profiles and the institutional positioning that is driving this liquidity. The stock is not just floating up on thin air, it is being aggressively bid up by a mix of short covering and speculative value hunting. Traders utilizing interactive broker stock trading platforms are seeing borrow rates fluctuate wildly as the bears rush to close out positions that were effectively printing cash just days ago. The pivot from $17 to the mid-30s in such a short time frame indicates a massive repricing of risk. The market had priced in a nearly 100% chance of delisting. Now that probability has dropped, perhaps to 50% or lower, and the share price is adjusting violently to reflect that new binary reality. This is comparable to the volatility we often see in Tesla stock, where sentiment shifts can wipe out or double capital in a matter of days. Yet the underlying mechanics here are far more precarious because they hinge on regulatory compliance rather than just car sales or margins. If you were sitting there with your Schwab intelligent portfolios or managing your own individual brokerage account, looking at this chart, you might be tempted to think the worst is over. But we need to scrutinize the specifics of the compliance plans Supermicro submitted to the Nasdaq earlier this week. They have stated they believe they can file their annual report for the year ended June 30th, 2024, and the subsequent quarterly report within the discretionary period the exchange allows. This is a bold claim. It implies that the new auditors, BDO, can do in a few weeks or months what Ernst Young could not do or would not do in months of work. If they succeed, the stock at $34 is mathematically cheap, trading at a single-digit price-to-earnings multiple that would make value investors salivate. If they fail, Or if BDO encounters the same roadblocks as their predecessor, the stock goes to single digits. This is the definition of a binary event, and it is why online investing communities are currently obsessed with this ticker. Let's step back and analyze the actual business, because amidst this accounting storm, there is still a company that manufactures the hardware powering the artificial intelligence boom. Supermicro is not a shell company. They are a primary partner for Nvidia's stock bulls and have historically been the first to market with liquid-cooled server racks that are essential for the new Blackwell chips. The irony of the situation is that the corporate governance is in shambles. The assembly lines are reportedly humming. They are shipping products. The demand for AI infrastructure is so insatiable that customers may not care who signs the audit opinion as long as the servers arrive on time. However, reports have surfaced that Nvidia is routing some orders to competitors like Dell and HPE Enterprise to mitigate supply chain risk. If this temporary diversion of orders becomes permanent, the fundamental growth story collapses regardless of whether they stay listed. This is the nuance that simple price watching misses. You might be using SoFi Invest to track the price action, but unless you're monitoring the supply chain chatter, you're missing half the picture. The intraday action we are seeing today, holding steady above the $34 mark, suggests that the market is digesting the BDO news with a degree of cautious optimism. The gap up yesterday was explosive, but the fact that it hasn't immediately retraced suggests buyers are stepping in to defend these levels. We are seeing a battle between the accounting fraud narrative and the AI infrastructure shortage narrative. Fidelity investments analysts and other institutional voices have largely suspended their ratings or moved to hold because the financial data is currently unverified. This creates an information vacuum. In the absence of verified financial statements, the market trades on signals and headlines. The appointment of BDO was a positive signal. The silence from the DOJ is a neutral signal. The continued delay of the 10K is a negative signal. The price you see is the weighted average of these conflicting signals. Now, I want to ask you directly. Comment below with your take. Do you think BDO will sign off on the books by February, or will they walk away like the previous auditors? And if you are brave enough to hold this through the volatility, tell me what your average cost basis is. Comparing this situation to other market phenomena, it feels less like a traditional tech investment and more like a distressed asset play. When you look at Apple stock, you're buying a fortress balance sheet and predictable cash flows. When you buy Supermicro right now, you're buying a litigation ticket with a lottery component attached. It is similar to the risks traders take with Robinhood crypto assets during volatile weekends. High risk, high potential reward, and zero guarantees. The sector momentum is also a factor here. The broader semiconductor index has been choppy, and investors are looking for the next leg of growth. If Supermicro fixes its filing issues, it instantly becomes the cheapest way to play the AI infrastructure trade. That is the carrot dangling in front of the bulls. The stick is the massive potential for restatements of past earnings. If BDO finds that revenue was recognized prematurely or expenses were hidden, the historical numbers we are relying on to calculate that cheap valuation could be revised downward, making the stock expensive even at these levels. Let's talk about the mechanics of what happens next. The Nasdaq has a process. The submission of the plan stays the delisting for now. The exchange will review the plan, which can take weeks. If they accept it, they will grant an extension, likely until February 2025. This gives the stock breathing room. Traders using Interactive Brokers trading software will likely see the non-compliant tag remain on the ticker, but the trading will continue on the main board. This liquidity is crucial. If they were forced to the OTC markets, many institutional mandates would force automatic selling, crashing the price. The fight right now is entirely about keeping that SMCI ticker on the Nasdaq Global Select Market. It is a fight for access to capital. Without the main exchange, raising funds to build more factories or buy inventory becomes exponentially harder. The involvement of BDO is interesting because they are a global top 5 accounting firm, but they are not Big Four: Deloitte, PwC, EY, KPMG. Some critics might say this is a step down, arguing that if the financials were clean, a Big Four firm would have taken the job. Others argue that BDO is hungry for market share and willing to take on a complex client that the Big Four are too risk-averse to touch. Regardless of the motivation, BDO's reputation is now on the line. They will likely be even more thorough than EY was, knowing the scrutiny they are under. This means the audit will be slow, painful, and likely filled with friction. Investors hoping for a quick, all clear in 2 weeks are likely deluding themselves. This will be a grind. We must also consider the retail sentiment. Platforms like SoFi Investing and Robinhood fractional shares have democratized access